You know that feeling when you see a property listing? There's an asking price, maybe you know what the last owner paid, and you wonder, is that really what it's worth? It
Yeah.
feels like value is just, oh, well, just a number somebody put on it, right? Whatever the market will bear today.
Yeah, that's a very common way to think about it. But it kind of glosses over what's really happening behind the scenes. See,
Mhm.
price is just a single point in time. It's a historical fact of what was paid. Value, though, that's a carefully considered estimate. It's an analysis based on specific facts as of a specific date.
Okay. So value isn't just this moving target or some gut feeling. It's actually a process. Maybe like being a real estate detective, digging into the evidence, or like a financial sculptor, revealing the true form beneath the surface.
That's a great way to put it, actually. A bit of art and science. And in this deep dive, we're going to use the sources you've brought together to really understand how that value is determined, what factors truly influence it, the different lenses professional appraisers use, and how understanding these basic tools can help you reveal a property's true potential. Turning that initial guesswork into educated estimates,
Educated estimates.
which is really key for wealth creation in real estate.
I like that. Okay, so let's start by untangling that core idea. We're talking about value, but the sources mention there are actually different kinds of value.
Absolutely. Price is just one piece of information, like we said. When we talk about value in a formal appraisal sense, the most relevant one for most people is probably fair market value, or FMV.
FMV.
That's essentially what a willing buyer and a willing seller would likely agree on. In an open competitive market, assuming both parties are informed and not under any pressure.
Okay, so FMV is kind of the standard, what's it worth in the market right now, benchmark.
Exactly.
Yeah.
But then there's also investment value. And this is interesting. This is the value to a specific investor. It's based entirely on their individual expectations, their required rate of return, maybe their specific tax situation.
Ah.
So an investor might see a higher or lower value in a property than the general market, just because of their unique strategy or circumstances.
So FMV is the sort of market consensus, but investment value is personal. That's a really important distinction, especially if you're looking at property specifically to make money.
Precisely. The sources also touch on others, intrinsic or fundamental value, which is more about inherent worth.
Mm.
There's going concern value for an operating business, liquidation value if you're just selling off assets quickly, and book value, which is really just an accounting term, not a true measure of market value.
That's true.
But usually it's FMV and investment value that you're most often dealing with or thinking about.
Right. Okay, so moving beyond just the price tag or maybe my personal investment goal, what factors actually create or influence that fundamental market value? What are the things the detective is looking for?
Well, beyond the obvious physical stuff, size, condition,
Mm.
the features, you really have to look at the legal details, things like easements, restrictions, any covenants. These aren't just footnotes on a deed. They directly impact how you can actually use the property.
Which affects desirability.
Exactly, which affects value.
Like a conservation easement that stops you from developing, or maybe rules about what kind of fence you can even build?
Precisely. Then there's the whole broader market context. Neighborhood trends are huge. Is the area growing? Is it declining? Maybe renewing? The sources mention these property life cycles: growth, development, stability, decline, renewal.
Hmm.
Where a property sits within its neighborhood cycle, that can dramatically shape its value trajectory.
Mm.
And of course, basic economic forces like supply and demand play out right there at that local level.
So even a picture-perfect house can be dragged down or lifted up by what's happening around it.
Absolutely. And leading right from that, a really crucial concept that appraisers focus on is highest and best use. This is maybe the single most important guiding principle.
Highest and best use. Okay, what exactly defines that?
It's the use of the property that is reasonably probable, legally permissible, physically possible, and financially feasible, that results in the highest value for that specific piece of land or property. It's not just what the property is today,
Mm-hmm.
but what it could be used for most profitably, given all the constraints and opportunities.
Okay, so that old house on a busy corner, maybe its highest and best use isn't as a house anymore. It might be worth more as, say, a potential small business site.
Exactly. If the zoning allows it, if it's physically possible to convert it, and if there's actually market demand for that kind of business in that spot, then yes. The sources gave that great example, of old office buildings in places like Manhattan converting to residential use as the market shifted. That's a perfect example of a change in highest and best use driving value.
That makes total sense. It really shows how value isn't static, it's dynamic. It responds to the market, to potential.
Right. And underpinning all of this are some fundamental principles of value that appraisers consider, like the principle of substitution. This is core to several methods we'll talk about. Basically, a rational buyer won't pay more for a property than it would cost to get an equally desirable alternative.
It feels pretty intuitive. Why pay $300K here if I can get something just as good down the street for $280K?
Exactly right. Then there's the principle of conformity. This suggests that properties in a neighborhood tend to hold their maximum value when they're reasonably similar in style, size, quality. Or you have regression and progression. A really high-value house plunked down in a much more modest neighborhood might actually have its value pulled down a bit. That's regression.
Okay.
Conversely, a smaller, more modest house in a really high-value neighborhood might get pulled up in value. That's progression.
So the neighborhood kind of averages things out, influences the individual properties.
It certainly does. And another key one is the principle of contribution. This says the value and improvement adds, like, say, adding a garage isn't necessarily what it cost you to build it. It's about how much that improvement contributes to the overall market value in the eyes of potential buyers. A $20,000 renovation might only add $10,000 in actual market value if buyers in that specific area don't highly value that particular feature.
Wow, that's a crucial one for anyone thinking about renovations, especially investors. It's
Yeah.
purely about the market value added, not the dollars you spent.
Absolutely critical distinction. So, okay, how do appraisers take all these factors and principles and then actually turn them into that educated estimate of value? They generally rely on three primary approaches, or as you call them, lenses, to view the property's worth.
The three lenses. Okay, let's start with the one that probably feels most familiar to people.
That would likely be the sales comparison approach, or SCA. It's definitely the most common for residential properties, and it relies very heavily on that principle of substitution we just mentioned.
Right. This is the one where they look at comps, isn't it? Comparable sales.
Yes, exactly. The appraiser finds properties that are similar to the one being appraised, the subject property, in terms of location, size, condition, age, features, and so on. And crucially, these comps must have sold recently. Then they make adjustments to the sale prices of these comps to account for any significant differences between them and the subject property.
Like if the comp had an extra bathroom or maybe a slightly bigger lot or needed a new roof.
Precisely. You adjust the comp's sale price up or down to make it more like the subject. This approach works best, obviously, when there are plenty of recent, reliable sales of very similar properties right there in the immediate area.
Makes sense.
It directly reflects what the market is demonstrably willing to pay for comparable alternatives right now. It's also the underlying basis for the comparative market analysis, or CMA, that real estate agents often prepare for sellers or buyers.
Although a CMA isn't quite the same as a formal appraisal, right?
Correct. A formal appraisal is more rigorous, follows specific standards, but the principle is similar.
Okay, so the SCA feels like looking at what the crowd is doing, what the market's actually paying. What's the next lens?
The next one is the cost approach. This approach looks at value from a different angle, basically, from the perspective of replacement or reproduction. It estimates the cost to build a similar new property today, then subtracts an amount for any loss in value due to depreciation, and then, importantly, adds the estimated value of the land the property sits on.
So it's like asking, what would it cost to replace this thing, but also factoring in that the current building isn't brand new.
Exactly. You first calculate either the replacement cost new, that's the cost to build something with the same utility or function using current modern materials and design standards, or the reproduction cost new. That's the cost to build an exact replica of the existing building, which can be significantly more expensive, especially for older, historic, or very unique buildings with materials or craftsmanship that are hard to duplicate today.
Okay. And then you subtract depreciation. But depreciation isn't just normal wear and tear, is it? I remember reading that.
No, that's a key point the sources highlight. Depreciation in appraisal terms is a loss in value from any cause. It absolutely includes physical deterioration, the roof leaks, the paint is peeling, but it also includes functional obsolescence.
Functional obsolescence.
Yeah, that means the property is less useful or desirable because of outdated design or features. Think of a 5-bedroom house with only one bathroom, or maybe a really awkward floor plan that doesn't flow well for modern living. Or inadequate electrical systems for today's needs.
Got it. Outdated design.
And then there's economic obsolescence, sometimes called external obsolescence. This is depreciation caused by factors outside the property line itself. Things like a new noisy freeway built nearby, or maybe a major local employer closing down and hurting the local economy, or even just a general economic downturn impacting the area's desirability.
Wow. That economic obsolescence is powerful. It's stuff you have absolutely no control over, directly impacting your property's value.
It really is. And it affects the value regardless of how well-maintained the property itself might be. So the basic formula for the cost approach is site value plus cost new accumulated depreciation, estimated value. The sources showed a simple example. The land is worth, say, $150,000, and the improvements, the house, garage, site work, would cost $450,000 to build new today. But there's an estimated $90,000 in total accumulated depreciation from all those causes, physical, functional, economic. They used 20% depreciation in their example. Then the value via the cost approach would be $150,000 for the land, plus $450,000 cost new minus $90,000 depreciation, which equals $360,000 for the depreciated improvements at the land. $150K plus $360K equals $510,000 total value.
Okay, yeah. Seeing the numbers makes the calculation really concrete.
Yeah.
When is this cost approach most useful then?
It's generally considered most reliable for new construction simply because there's very little depreciation to estimate, which can be tricky. It's also essential for valuing specialized properties. Think schools, hospitals, government buildings, churches, things that don't sell very often so you don't have good sales comps.
Right, hard to find comps for a hospital.
Exactly. In those cases, the depreciated cost, sometimes called depreciated replacement cost, or DRC, is often used as the best available indicator, a sort of surrogate for market value.
Okay. So if you can't easily compare it to recent sales, you figure out what it would cost to rebuild it and then adjust for its age, condition, and any obsolescence.
Okay, makes sense.
What's the third lens?
The third major approach is the income approach. And this one is absolutely critical for properties that are bought and sold based on their ability to generate income. So think apartment buildings, shopping centers, office buildings, industrial warehouses.
Right. This is where you really start looking at the rent checks, basically.
Yes, but in a very structured way. This approach directly connects the property's value to the expected financial return it can produce for an investor. It explicitly considers the factors that investors care deeply about. Things like the perceived risk, the property's liquidity, the amount of management effort required, the potential for future appreciation, maybe even tax advantages. Generally speaking, higher perceived risk or lower potential return usually translates into a lower value estimate, all else being equal.
Okay, so how do you actually calculate value based on income? What's the process?
You start by estimating the absolute maximum income the property could generate. That's called potential gross income, PGI. Think of it as the total rent if every single unit or square foot was occupied and paying the full market rent 100% of the time.
The ideal scenario.
The ideal, yes. Then you have to adjust for reality. You subtract an allowance for vacancy and collection loss, V&C. This accounts for expected empty units or space, and also for rent that you might not be able to collect for various reasons.
So factoring in that it won't always be 100% full or everyone pays on time.
Exactly. You might also add in any miscellaneous income, things like fees from laundry machines, parking, vending machines, etc. PGI minus that vacancy and collection loss, plus any miscellaneous income, gives you the effective gross income, EGI.
Okay, EGI, that sounds like the realistic gross income you actually expect to receive.
That's right. It's what you reasonably anticipate collecting. Now, from EGI, you subtract the operating expenses. These are the necessary costs to actually run and maintain the property, things like property taxes, insurance, management fees. Even if you manage it yourself, you estimate a fee, utilities, repairs, maintenance, landscaping, all that stuff.
The day-to-day running costs.
Yes. And crucially, the sources emphasize including reserves for replacement. This isn't a typical operating expense you pay out each month, but it's vital for long-term value. It's an annual allowance you set aside conceptually to pay for future major capital expenditures, things that wear out over time, like replacing the roof, the HVAC system, repaving the parking lot.
Ah, so you account for those big future costs now.
You should, yes. A common way to estimate it is to take the estimated cost of replacing that major component and divide it by its expected economic life. For example, if a new roof costs $20,000 and is expected to last 20 years, you'd ideally budget a reserve of $1,000 per year. $20,000, 20 years.
Got it. So setting aside money, or at least accounting for the need for it, for those big future repairs, is treated like an operating cost. That makes a lot of sense for accurately judging profitability.
It absolutely does,
Oh.
because those replacements are necessary to maintain the property's condition and its ability to continue generating income over the long haul. So you take your effective gross income, EGI, subtract all those allowable operating expenses, and subtract the reserves for replacement. What you're left with is the key income figure, net operating income, NOI.
NOI.
NOI represents the property's net income from its operations before accounting for any debt service mortgage payments or income taxes paid by the owner. It's purely the property's operating performance.
So NOI is basically the property's profit from its operations before financing costs. How do you then turn that NOI number into an actual estimate of value?
This is where the capitalization rate, or cap rate, comes in. The cap rate represents the rate of return an investor would expect to receive on their investment from the property's annual NOI. The core relationship, often called the IRV formula, income rate value, is value equals NOI, cap rate.
Value equals NOI divided by cap rate. Okay, so doing the math, a higher NOI means a higher value, obviously, but a higher cap rate actually means a lower value for the same amount of NOI.
Precisely. You got it. A higher cap rate implies that investors are demanding a higher rate of return to compensate for something, maybe higher perceived risk, maybe less desirable market conditions, maybe expectations of lower future growth. It essentially tells you how the market is currently pricing income streams for that type of property in that location.
So how do you know what cap rate to use?
That's the art and science part again. Cap rates are usually derived from the market. Appraisers analyze recent sales of comparable income-producing properties. They figure out the NOI for those sold properties and divide it by their sale price. NOI sale price equals cap rate. This gives them an indication of the cap rates the market is currently accepting for similar investments.
Ah, okay. So you look at what rate of return buyers were implicitly willing to accept when they bought comparable properties recently, and then you apply a similar rate to your property's income stream.
That's the fundamental idea, yes. Selecting the appropriate cap rate is absolutely vital because, as the sources really underscore, even a seemingly small difference in the cap rate, say, 0.5%, can significantly change the final estimated value.
Yeah, I can see that mathematically.
And market cap rates themselves are influenced by a whole host of factors. The property type, retail versus apartments versus office, the specific location and its prospects, the property's condition, the quality and lease terms of the tenants, anticipated future rent growth, and also broader macroeconomic factors like prevailing interest rates, GDP growth, unemployment rates. It all filters down into that market cap rate.
Wow, that really connects back to those investor factors you mentioned earlier, risk, market conditions, future potential. They all kind of get baked into that cap rate number.
They absolutely do. Now, the sources also briefly mentioned some simpler, quicker metrics like the gross rent multiplier, GRM, or a gross income multiplier, GIM. GRM is just sale price divided by gross annual rental income. GIM uses effective gross income instead. They're useful for a quick comparison between very similar properties.
Like a shortcut.
Kind of a shortcut, yeah. But they're much less precise than a full analysis using NOI and cap rates because they completely ignore operating expenses, vacancy differences, and reserves.
Right, so GRM or GIM might give you a quick ballpark, but for a real deep dive into profitability and value, you need to get down to the NOI and the cap rate.
Exactly. Now, let's bring this all back to you, the listener, perhaps looking at potential investments or just trying to understand property value better. How does understanding these three different approaches, sales comparison, cost, and income, help turn that initial guesswork into those educated estimates we talked about?
Well, I guess starting with the sales comparison approach, it tells you what buyers are actually paying right now for similar stuff. It gives you that crucial market reality check.
Yes, absolutely. It provides the baseline of current market acceptance. What about the cost approach? How does understanding that help?
The cost approach. I guess it helps you understand if the asking price seems justified by the actual physical components of the property, the land and the building. And maybe importantly, it highlights potential future costs because of that depreciation factor, like knowing the roof is nearing the end of its life or the HVAC is ancient. That comes out of the depreciation calculation, right? So it signals potential capital investment needed down the line.
That's a great point. It helps assess physical condition and potential future outlays. In the income approach,
Well, that seems like the powerhouse for investment properties. It gives you the tools to really dissect the financial performance. Calculating the NOI shows you the actual operating profitability, stripping out financing. And comparing the property's implied cap rate to market cap rates tells you if it seems fairly priced relative to its income stream and perceived risk level.
Exactly.
Plus, drilling down into the components, the vacancy rate assumptions, the specific operating expenses, whether reserves are properly accounted for, that lets you identify potential upsides, maybe areas for efficiency, or perhaps hidden costs or risks.
You can really start to analyze the factors influencing those cap rates too. Location trends, tenant quality, lease expirations, to assess not just current income, but future income potential and the associated risks.
Yeah, this really does provide a much more structured framework for analysis. It goes way beyond just, liking the look of the house or thinking the neighborhood is nice. It's about understanding the underlying mechanics of value.
It's about applying systematic analysis, using these different but complementary lenses to arrive at a supported, well-reasoned value estimate, which, by the way, is exactly what professional appraisers do. They follow strict standards, like the Uniform Standards of Professional Appraisal Practice, USP, here in the U.S., which require competence, ethics, independence, and objectivity. And the sources note their process always starts by clearly defining the problem. What specific type of value is being estimated? For what intended use? And, critically, as of what specific date?
It makes sense that it requires that kind of structured process and solid data to back up the conclusions. It's not just pulling a number out of thin air.
Definitely not. It's essential for credible results. It's all about understanding that while the day-to-day market price might fluctuate based on immediate sentiment or negotiation, the underlying value estimate comes from a more rigorous, methodical analysis of the property itself, its potential, and the broader economic and market forces acting upon it.
So we've really journeyed from thinking of value as maybe subjective or just the sticker price to seeing it as the outcome of some pretty serious digging into the property's physical and legal details, the market forces around it, and applying these specific analytical methods, sales comparison, cost, and income. It definitely shifts the perspective from pure guesswork to a much more informed strategy for anyone involved in real estate, especially if, as you said, they're looking at it as a way to build wealth.
That systematic, multi-lens approach is really the foundation for making sound decisions.
Okay, so here's a final thought to leave everyone with, kind of building on all this. Given how much external factors, things like interest rate shifts, broad economic conditions, even just shifts in neighborhood reputation or desirability, can influence something as critical as a market cap rate or simply the number of willing buyers out there. How much of a property's determined value is truly inherent to the actual bricks and mortar, the physical asset itself, versus being essentially a reflection of the market, the economy, and maybe even the collective psychology surrounding it at that particular moment in time.